So welcome to Brookings. I hope everyone has their taxes filed and can relax and enjoy our program this morning. Equities are important for the economy, making up a large part of most retirement portfolios and financing growth and investment. But there are concerns about our economy. Many households are anxious about how to manage their own retirement funds, while capital spending and startup companies are both down. How are American equity markets working, and are they playing the role they need to play in our economy? We have a great lineup of people today to talk about that, and we're going to start. It's my great pleasure to introduce Richard Ketchum, who is Chairman and CEO of FINRA. Everyone has bios here, so I don't need to go at length. I'll just mention that prior to becoming CEO of FINRA, Mr. Ketchum was CEO of NYSE regulation from 2006 to 2009. He served as the first chief regulatory officer of the New York Stock Exchange, a position he began in March 2004. From 2003 to 2004, he was general counsel of the corporate investment bank group of Citigroup, and previous to that, he spent 12 years at NASD and the NASDAQ stock market, where he served as president of both organizations. Prior to that, Mr. Ketchum was at the Securities and Exchange Commission for 14 years, with 8 of those years as director of the Division of Market Regulation. So will you please welcome Rick Ketchum.
Thanks, Martin. Good to be with you all. And Martin, particularly, I want to commend you for the work you do here in Washington, bringing a greater understanding of the interface between business and the economy. I think on the other side of 2008, 2009, and Dodd-Frank and the variety of things in Europe, there's never been a more important time for the work that you're doing. And it's a pleasure for me to be here today to participate in this important discussion on the role of equities in the economy. I want to focus my remarks this morning on one aspect of this broad topic, the important role of the securities markets for retail investors. Having been involved in securities market regulation for a really long time, I've got a great appreciation for the regulatory changes over the years that made the U.S. markets more accessible for retail investors. The 1975 Act amendments to the Securities Exchange Act of 1934, which mandated the creation of a national market system, the implementation of Regulation National Market System, or Reg NMS, in 2007, and a variety of other actions brought a series of positive effects for investors and spurred a technological revolution that continues to this day. As a result of these regulatory changes, investors now benefit from lower trading costs, tighter spreads, timely execution of firm quotes, a wider variety of order types to achieve their investment objectives, maybe every once in a while too many order types, and the availability of multiple innovative trading platforms. Investors today can pay as little as $4.99 or less for a stock trade and get instantaneous electronic confirmation. Compare that to 1975, when it would have cost an investor hundreds of dollars to buy 500 shares of a blue chip company. Because fixed costs were the norm, an investor buying 100,000 shares of the same blue chip stock would have paid the same amount per share for the trade, and fundamentally restricting the effective operation of institutions in this country. Since the 1980s, the number of households owning equities, whether individual stocks or mutual funds, has increased significantly. You all know these statistics, but just to go over them quickly. Today, nearly 54 million, or 43% of U.S. households, own mutual funds, which represents a significant component of the savings investment of many U.S. households. Indeed, the democratization of the markets for retail investors is probably the most notable inflection point in markets, certainly in my lifetime. This growth isn't all due to regulatory changes. As companies have shed their defined benefit plans and shifted instead to defined contribution plans, consumers have assumed the greater responsibility for wealth building and retirement saving. According to the ICI's 2015 profile of mutual fund shareholders, between mid-2000 and mid-2015, assets held in mutual funds increased from $7.1 trillion to $16.1 trillion. And ICI's 2015 fact book tells us that retail investors hold the vast majority, 89%, of that $16 trillion in mutual fund assets. Looking at these statistics, I can only come to one conclusion. The securities markets are of great importance for retail investors, and retail investors are important for the securities markets. Now the questions posed for this event. What role equity markets can play for individual retirement, security, small business investment, and whether they can jumpstart American innovation culture by fostering the transition from startups to billion-dollar companies. Those questions are exceptionally wide-ranging and frankly beyond my reach to deliver in a single talk, but they all begin with the fundamental question of whether the efficiency, flexibility, and fairness of the equity markets is sufficient to encourage retail investors to participate directly and indirectly in the marketplace to a degree that supports continuous and diverse capital raising. It is this more narrow question that I'll try to structure my remarks around. The only constant to describe the equity markets has been change. And when you examine the changes that have occurred as a result of technology and regulatory action, it's frankly breathtaking. The SEC, through enacting its order display rule, decimalization, and Reg NMS, made a momentous decision to increase competition, reduce barriers to entry, and expand the interaction of orders. These changes also caused a shift from an environment where the New York Stock Exchange and NASDAQ stock market accounted for the vast majority of equity trading, and where single specialists, or a relatively small number of market makers, dominated price discovery to equity markets, characterized by fragmented trading across a dozen or so exchanges, more than 40 automated trading systems, and a countless number of active traders who directly impact price formation. As I discussed earlier, the result has been a market which, by classic statistical measurements, delivers the ability to handle vast amounts of trading volume at considerably lower cost to both retail and institutional investors. And yet this success story is greeted with substantial concerns regarding the market's lack of transparency, tendency towards periods of extreme volatility, allegations of unfairness, and finally concerns of creating an inhospitable environment for smaller public companies. In the last few years, we've heard a lot about allegedly rigged markets. While I can assure you that the markets are not rigged, the concerns I described earlier raise valid questions about the structure of the markets. Since it underlines much of the perception of unfairness by investors, let's start with the concerns raised by extreme volatility, with the May 2010 flash crash operating as the logical starting point. I won't spend time restating the specifics of the extraordinary volatility that day, but instead focus on the conclusion that notwithstanding the positive impacts gained from a more competitive open market structure in normal trading times, the flash crash demonstrated that the equity market, when placed under pressure, was considerably more fragile, or as some might suggest, unsafe at any speed. The reason for this fact is not really difficult to discern. In the previous centralized market environment, most orders traveled to a single market, providing the specialist with the opportunity, when faced with a sudden imbalance of buy and sell orders, to call an immediate trading halt and effectively impose a new price-setting auction before reinstituting continuous trading. This was not so easy in the highly electronic, fragmented environment in 2010. While the majority of high-frequency trading effectively employ market-making instead arb strategies across the equity and derivatives markets, they suffer from the limitations of algorithmic coding, which generally avoids addressing extreme market volatility because of the risk of other market participants having access to superior market information. Accordingly, when market-making algorithms encounter exceptional imbalances of buy and sell orders, they tend to drop out of the market until a human trader concludes that it's safe to return to the water and that Western civilization is indeed not ending. This creates effectively a vacuum in liquidity just when it is most needed. Since the May 2010 flash crash, the SEC, FINRA, and the U.S. stock exchanges have implemented a variety of initiatives to minimize the impact of extreme volatility. These initiatives have created a multifaceted safety net for the markets and are designed to promote investor confidence. Among the changes, regulators adjusted the market-wide trading pause, or circuit breaker, which gives market participants an opportunity to assess their positions, valuation models, and operational capabilities when extreme periods of volatility occur. More importantly, we eliminated what was called, for those of you familiar for how things are handled in the futures markets, a limit up, limit down initiative, which addresses the type of sudden individual stock price movements that the market experienced during the flash crash. Under the plan, a limit up and limit down mechanism prevents trades in national market system stocks from occurring at prices outside of certain ranges. And if the changes in price are more significant and prolonged, the limit up, limit down plan would trigger a trading pause in that security. We had an excellent opportunity to evaluate the effect of these changes last August 24th, when the Dow plummeted more than 1,000 points within the first 10 minutes of trading. The events of last August illustrated not a market out of control, but the value of having appropriate controls in place and the importance of continuing to review how they're in place. Were it not for the limit up, limit down procedures, the market fluctuations last August, to my mind, would have been more dramatic. There were more than 1,200 trading pauses that day, with more than 1,000 occurring in exchange-traded products, many of which were repeats in the same exchange-traded product. Clearly, the August event showed that refinements to these processes are serving a critical function, but also showed that additional enhancements are necessary. For example, while the index recovered a portion of the early losses, the extreme volatility raised questions about the operation of exchange-traded funds and equities more generally. One of the issues that day was the big gaps between the value of underlying indexes and the exchange-traded funds that track them. ETFs combine aspects, of course, of mutual funds and conventional stocks. They operate like a mutual fund by offering an investor an interest in a professionally managed, diversified portfolio of investments. Unlike mutual funds, however, ETF shares trade like stocks on exchanges and can be bought or sold throughout the trading day at fluctuating prices. On August 24th, unusual trading affected many of the major ETFs. While trading volume surged, public trading display of trading interest or liquidity dropped, and we saw pricing volatility in ETFs partially because of the conflicts between halts on the underlying stocks within the indices and the pricing of the index. The volatility and the issues we saw with ETFs offer a great opportunity for the SEC, with input from its recently formed Equity Market Structure Advisory Committee, of which I'm a member, to take a look at the effectiveness of the initiatives put in place after the 2010 flash crash, as well as our market structure generally. Among the issues that I think are ripe for review are the opening processes on primary listing exchanges, the operation of the limit up and limit down at the opening of trading, at reopenings after a trading pause, and where the price is rebounding. The use of single market prices rather than consolidated prices for index calculations at times when the primary market opens outside its normal process. The use of stop orders, which become market orders when triggered and can execute a price substantially worse than anticipated by the investor, particularly in volatile markets. And whether market-making quoting obligations from the standpoint of high-frequency trading firms are stringent enough to promote market stability. Liquidity in the U.S. markets has thrived because of confidence in the markets, and investors need to be sure that the markets will operate predictably. And it's important for us as regulators to implement programs that minimize the impact of market volatility and to limit market disruption. Second point I want to raise is market fairness. Investors must have confidence that they can access current, accurate, bona fide market prices that reflect true investor supply and demand. Market structure must provide retail investors with accurate prices and low trading costs. I've been part of many significant regulatory changes that have benefited investors, but it is critical that any equity market structure review focus on retail investor confidence. The Equity Market Structure Advisory Committee, of which I'm a member, as I mentioned, also has been focused on that aspect of the markets and been considering initiatives to protect investor interests and promote investor confidence. These initiatives include finding ways to provide more granular and meaningful information to investors through amending what referred to as the SEC Rules 605 and 606, which provides basic execution information from the standpoint of both institutional and retail transactions, and also seeking opportunities to educate retail customers on things like order types and market volatility. One of the concerns raised by the new market environment is whether information that is available from all trading venues allow investors to assess valuations in a timely and accurate manner and enables regulators to investigate and analyze market events. And both we and the SEC, FINRA and the SEC, has taken steps to enhance transparency in the markets. Dark pools is clearly one of the areas where there's been a great deal of attention with respect to that. And a substantial part, as all of you know, a substantial amount of trading today takes place in dark venues, which are not transparent in many respects. For example, the orders placed in a dark pool are not displayed, and while a trade once executed within a dark pool is reported to the tape, the trading by an individual dark pool is not separately identified. So while dark pools have their place in the financial market ecosystem, subject to appropriate regulation, we're right to be concerned about their lack of transparency. We've taken steps to increase market transparency of alternative trading systems, including dark pools. We currently make the volume and trade count information for equity securities executed in an automated trading system, some of whom are dark pools, available on the FINRA website, and plan later this year to start providing additional information about the levels of block activity as well as other information. In addition, the SEC's recently proposed amendments to Reg ATS, a bit controversial in their specifics, that I think go directly at the type of questions from the standpoint of clear disclosure with regard to how ATSs handle orders, how their matching systems operate, and provide greater assurance that how they treat various different participants is clearly and totally disclosed. Competition and regulatory changes have also led to a more complex and fragmented market. In today's increasingly fragmented market, bad actors can consciously disperse their trading activity across markets, asset classes, and broker-dealers in an attempt to hide their footprints and avoid detection. And it's part of our job, indeed a critical part of our job at FINRA, to monitor what's happening in the market and ensure that the markets operate fairly. It's absolutely critical that anyone looking at market surveillance has a bird's eye view across all markets, given the way trading occurs today. Through our agreements with exchange clients, we've been able to reach that point, monitoring more than 99% of the listed equity market and over 65% of the listed options market. That's allowed us to develop cross-market surveillance programs that run dozens of surveillance patterns and threat scenarios across the data we gather to look for manipulation and front-running, as well as layering, spoofing, algorithmic gaming, and other abusive conduct. This sophisticated surveillance allows us to detect activities we were not able to see before. For example, 47% of our cross-market alerts identify potential manipulative activity by 2 or more market participants acting in concert. And 60% of our cross-market alerts identify potential manipulation by a market participant on multiple markets. This isn't surprising because of the change in the impact of pricing formation today, from a world where that was capable for a very small few entities to a world in which high-frequency traders spread around both the United States and throughout the globe are impacting through and can shift their activity from firm to firm to be able to cover any manipulative activity. I'll just mention briefly, without talking further, although you'll see more in my remarks, that the SEC's proposal with respect to the implementation of a consolidated audit trail, or CAT, is a critical next step from the standpoint of creating investor confidence and ensuring an environment where there's less opportunity for manipulation. If you will, the more granular information provided in a consolidated audit trail, identifying the trading of active traders, allows a regulator to move dramatically more quickly to identify where there is a problem from the standpoint of high-frequency trading activity. As the markets continue to evolve, there are several other lessons that we need to keep in mind. In particular, I'd like to focus on the impact of decimalization and the minimum pricing variation in which securities can be quoted and traded, particularly decimalization in the U.S. equity markets. While the academic literature indicated a number of potential benefits from decimalization, such as an overall reduction in effective and quoted spreads, there was some evidence that, at least for some small-cap stocks, the decline was not statistically significant. The academic literature also found post-decimalization evidence of a decline in a quoted depth on average, smaller trade sizes, and an increase in the total time to work institutional orders. The SEC's report also noted the U.S. has a flat one-size-fits-all tick size regime as compared with many foreign jurisdictions that have adopted tiered regimes where the tick size varies depending on the price level of a stock. Now, the SEC led a decimalization roundtable discussing these issues, and I think properly concluded that legitimate questions have been raised as to whether the minimum tick size regime for U.S. equity markets should be refined and mandated, and that there be a targeted short-term pilot program to assess whether wider minimum tick sizes for small capitalization stocks would enhance market quality to the benefit of market participants, issuers, and U.S. investors. So as seems to always be the case these days, while this pilot has taken a while to be developed and has gotten remarkably complex with respect to the alternatives that are involved. But as part of this and part of the SEC's request, the exchanges in FINRA have implemented an NMS plan that requires wider coding and trading increments for certain small cap equity securities on a pilot basis. The criteria for the securities to be included in the pilot included a market cap of $3 billion or less, an interesting definition of small cap, consolidated average daily volume of 1 million shares or less, and a closing price of at least $1.50. The pilot consists of 3 test groups of 400 securities each and a control group. Okay, got to hold on to your hat to deal with these details. Test Group 1 securities must be quoted in 5-cent minimum increments, but may continue to trade at any price increment that is concurrently permitted. Test Group 2 securities must be quoted in 5 cents minimum increments and can only be traded in 5-cent minimum increments. And finally, Test Group 3 securities must be quoted and traded in the 5-cent minimum increments, but also subjects trading away from an exchange to a trade at rule, similar to what has been implemented in Canada for a couple years now, that essentially requires some level of meaningful price improvement if trades are going to occur away from an exchange. Should be fun. The tick size pilot plan also includes extensive data collection requirements, because really any evaluation of the theory that as to whether this does deliver value requires that, including data relating to market quality, market maker participation, and market maker profitability. We will provide the data to the SEC and publish it in an unattributed and aggregated basis to make it widely available for research and analysis. The pilot goes into effect this October, with pre-pilot data already started this month. I'm a huge fan of pilots, and I think as someone who spent a good deal of his career in the NASDAQ stock market, I care deeply about the ability of public markets to be able to support trading and the ability to raise capital with respect to smaller companies as an alternative to the private capital regime. But I do think there's a couple of things to know. There's a lot of things that are different than the 1980s and 90s with respect to when small capitalization financing really flourished. One of the things is we're on the other side of the NASDAQ bubble as opposed to the first side of the NASDAQ bubble. There are 2 other parts that made financing small cap stocks much more profitable at the time. One was the greater flexibility for the analyst to become a cheerleader with respect to those securities that personally I think has been an important step in regulation to eliminate. And the second is the reality of a NASDAQ market at that time in which trading with regard to those small cap stocks were dominated by the lead underwriter in most cases, remarkably profitable during the first couple weeks of trading for that lead underwriter, and in which there may have been a little bit more flexibility from the standpoint of suitability analysis than existed at the time today with respect to recommending those offerings. I think it's great to look for ways to encourage sponsorship with respect to small cap stocks, and we should do that. We don't need to move to an environment that may once again put investors at peril. Well, I could talk personally about market structure all day. The concerns of investors obviously go way beyond market design. Equally damaging to healthy capital markets are the all too numerous industry compliance breakdowns that have harmed investors. Whether it be regarding the packaging of subprime mortgages, the marketing to retail investors of complex and liquid products, the lack of transparency of many direct and indirect fees, and the shocking efforts to manipulate a range of market indexes, these failures have led investors and clients to question the industry's commitment to put their interests first. Now, there's obviously been an overwhelming regulatory response to these events, some of which FINRA has taken, but mostly relate to ranging across Dodd-Frank to the most recent inflection point of the DOL's rulemaking regarding retirement plans. I leave to the next panel to discuss if they want the road of effectiveness of those efforts. However, I think it is important to recognize, and probably a difficult thing for a regulator to cope with, that rules alone cannot address the very real challenges that financial firms have in ensuring not getting bad people out of their firm or out of the industry. Financial firms do that and do that well, but ensuring that good people do not take actions that harm their clients and expose their firms. This is truly a challenge because you don't walk through with respect to the people operating in the financial industry and easily identify the ones that are going to make that misstep. Okay? They're the same people in your MBA classes or your law school classes that you would have been glad to go out and have a beer with. And they stay that way, having worked out with them at Citigroup on the other side of the problems that they may have been involved with or caused. And the challenge of identifying those persons or creating less temptation and less incentives is really an enormously difficult challenge for the financial industry, always has been, but particularly given the complexity today, even more. Accordingly, I want to take a minute to talk about culture at broker-dealer firms. After nearly 40 years in the securities industry, I can say unequivocally that firm culture has a profound influence in how a securities firm conducts its business. And I've seen over the years how a culture that doesn't value ethical behavior leads to failures for the firm and significant harm to investors. It's important that the securities industry embrace a culture that puts investors first and clients first. A culture that consistently places ethical considerations and client interests at the center of business decisions helps protect investors and the integrity of the markets. FINRA has been focused on firm culture for some time, as many regulators around the world, including the Fed, FCA, and the like, have as well. That starts with a focus on conflict of interest and professional ethics, and we think firms should also be paying keen attention to these related areas. In 2013, we issued a report on conflicts of interest that highlighted some best practices. We're also concerned about conflicts that a firm's compensation system may create. Specifically, conflicts in the compensation area can impact the quality of advice provided to investors, especially to retail investors. In our reviews with firms, FINRA will assess 5 indicators of firm culture: whether control functions are valued within the organization, whether policy or control breaches are tolerated, whether the organization proactively seeks to identify risk and compliance events, whether supervisors are effective role models of firm culture, and whether subcultures, e.g. at a branch office, a trading desk, or an investment banking department, that may not conform to overall corporate culture identified and addressed. Now let me say what we're not going to focus on, and also what's the risk of focusing on these soft things from the standpoint of the regulatory interface with the firms. We're not about deciding and identifying firms that don't get it. Regulators must fundamentally be about outputs and be about what things that actually impact on the other side in an adverse way, investors or markets. But at that same time, we are about making risk-based decisions as to where we focus our attention with respect to firms' activity and which firms we focus more attention. And firms fundamentally need to be focused from the standpoint of culture, because what I believe has become very clear, notwithstanding the enormous commitment and investment in compliance functions and technology over the last 15 years, that a rule-based approach from the standpoint of compliance simply is not enough to cut it, and simply does not eliminate the risks here. So I think there's a common cause across regulators and firms to get at this soft area and begin to wrestle with and as much as possible. And I think as well, those that are interested and focused in studying from the financial industry in order to try to increase the science of addressing the questions of what make good people do bad things. I'll close now. I look forward to the conversation. It's great to have the chance to talk to you. I do think that I look forward very much to the panel and the broad. You can think of an enormous manner of ways to really try to look at how equity markets and equity investments impact our economy. And I look forward to the rest of the day. Thank you.
Thank you. If you're willing to sit here and one seat between us, so we're not out of here. And we're going to
We could just shout.
Yes, but this is easier. Take advantage of the technology. So thank you so much, and I'm going to ask the audience for questions, but I'm just going to start us off with a couple of questions. You mentioned dark pools, which is something that, attracts a lot of people's attention, and they think, what's that? Does that sound like something that's unfair? It sounds like dark energy that I don't understand, or Lord of the Rings, darkness or something. So let's talk for a minute about dark pools. First of all, is there some positive element to dark pools? Is a dark pool something that we should be willing to tolerate because they play a positive role?
Sure. First, if you look at the generation and the history of dark pools, They essentially come.
Can you just tell everybody what's the definition of a dark pool?
Well, a dark pool is an electronic trading system. This is not an SEC definition, but essentially an electronic trading system that, because it hasn't reached a percentage of order flow and because it has not been required to register as an exchange through SEC's Reg ATS, does not have to display pre-trade transparency. It must report all its trades, just as any firm that executes a trade must report their trades on a post-trade transparency standpoint. But it does not, if you will, have to display the liquidity that exists in the system, whether it be with respect to quotes or a range of more complicated orders.
I do want to mention before we go on that we have about 90 people are registered for the watching us on the online. So we do have the ability to go outside this room. So you are sort of speaking to that audience.
Now you asked is there positive impacts in this? And I think
yes.
Sort of described. Essentially, dark pools respond to the continuing frustration that occurred over time by institutional investors with regard to information leakage and regard with the fact of the cost of executing block transactions. And the history of dark pools, though it has evolved from there, really begins there. As we move to a much quicker electronic marketplace, institutions divided up their orders into much smaller executable size, but they continued to have the challenge with respect to price movements and price impact with respect to large size orders. Economically, you'd expect that to occur. The question is, how do you minimize it? So dark pools, by not displaying post-trade transparency, allows for an opportunity, in the first design from the standpoint of few that are truly about trying to execute large trade size, allows for exactly that type of transparency. Now, the next set of things, which again reflects the change of our markets with respect to automated trading, is it provided an alternative for institutional investors in particular to look for price improvement without interacting with respect to the lit markets that, as a basic part of their statute, are required to be non-discriminatory and can't restrict any participation, which is another way of saying they can't restrict the participation of professional high-frequency traders. Many institutional traders, this is not to return to the book and talk about latency arbitrage, but many professional traders were concerned about the ability, particularly until they increased their sophistication with respect to how they manage their executions. Their concern was the ability of tipping off and encouraging trading running ahead of them by a range of probability assessments that trading has occurred. So those are the positive things that ATSs do. There are a bunch of concerns, which I guess may be your next question.
Okay, so tell me about the downside, which you referred to a little bit in your speech.
Well, the downside, or at least the arguable downside, is a variety of things. First, these are less transparent systems, so the ability to understand more about the supply and demand developing in the markets is more difficult to analyze. Secondly, because they get to pick and choose who participates in the system, there's risks that they may not fully and accurately disclose the restrictions of participation they have, that in one way or another can be discriminatory or mislead institutional investors who think that they're trading in an environment where there aren't active traders when obviously some of the disciplinary actions are brought suggest that's not true. Now, the third argument would be the question of how you feel about interaction of order flow and how you feel about the fragmentation that exists in the United States markets today and a lesser extent in Europe. ATSs are, by finding different pools of liquidity or by a goal of finding pools of liquidity, and it should be said that most ATSs today have an average trading size of a couple hundred shares, so they've gone a long way from their institutional block roots. Arguably, you're reducing efficiency from the standpoint of pushing all buy and sell interest to a single place. Instead, you're pushing it now to 12 exchanges, 50 or 60 ATSs, and upstairs firms that also have the ability to trade against retail order flow themselves. So the argument would be the other concern outside of controlling for disclosure and increasing transparency would be that you're creating an inefficient market structure. Statistics don't drive a conclusion that that's correct.
although your statistics obviously always have to take the market that exists in evaluating it. But certainly it shows generally that there are pretty good structures from the standpoint of providing liquidity and finding price improvement.
Thank you. Let me turn my next question, then I'm going to ask the audience for questions. We've seen a fairly steady decline, well, I shouldn't say that because now maybe it's picking up a little bit in the number of startup companies in the United States. Now, obviously, the recession had quite a bit to do with that, but we've been recovering now for a number of years. There's a lot of people, including me, that see startups, particularly that the percentage of them that are gazelles and grow rapidly, as being important to both the overall growth of the economy and the employment growth. There's also been a decline in the number of companies going public, which may be, in a way, is natural if the number of startups is down and so on. Now, there are various reasons for this, that private equity plays a bigger role, companies sell to larger companies and so on. But are you concerned about that, and do you think there's anything, there is some discussion of startups going to London. Do you feel our markets are in a good competitive position? Are you concerned about whether going public is too expensive or too costly? How do you view that
I think it's a valid concern, but I think there has to be a realistic discussion of a variety of pieces, as I briefly indicated in my talk. Look, part of the shift in IPOs reflects the growth of a global economy and is basically a good thing. And as innovation no longer fully focuses in the United States, and as other markets that were really inefficient from the standpoint of encouraging capital markets have changed and adjusted, some of that's fairly natural. Some of the points you raise, I think, deserve a review. The tick test pilot seems to me to be one small piece of that. But certainly the other piece that suggests it deserves a review is the enormous growth of the Reg D market, and certainly the significant participation of that from the standpoint of international securities, but also as a means in a variety of ways for companies to either raise capital or raise funding without going in the public markets. I think Chair White's been right in kicking off a review from a disclosure standpoint. I think, I noted my concerns of not returning back to some of the regulatory gaps that existed in the 80s and 90s, but I take this from FINRA's standpoint as well as the SEC. I think we need to step back and look and ask whether some pieces of the regulatory structure, as it starts to apply to different types of broker-dealers and smaller firms, need to be streamlined with respect to small-cap stocks. So I think tick test pilots are a good way to start at this.
Right.
But I think looking at those set of questions, not from the standpoint of unicorns, not just from the standpoint of the most attractive private capital securities, they do just fine, and I think their choices come from decisions, rightly or wrongly, of how to maximize their return from the standpoint of the company. But as you move to the tier down, that's not in the hot industries, that is a more complex story or simply needs that capital to continue to maintain and suffers from the inefficiency of depending purely on bank financing, it seems to me that it is right for us to look at our regulatory set of regulatory requirements and ask where they can be streamlined.
I'm looking for questions. Yes. Could you identify yourself and just wait for the mic so that the audience online can also hear you? Apparently,
Dead mic.
We have a dead mic. So why don't you just go ahead and we'll repeat.
I guess could walk up to there if you want, or just
why don't you just ask the question and we'll repeat the question.
I think that the public was sold liquidity with the high frequency. What it really did was offset risk onto where you have operates as an exchange step aside. That's the real risk that high-frequency. I personally would like to see a transaction tax if your holding period is less than an hour or less than a day, unless you are truly an exchange. I think the public would happily give up the volatility or give up the public would happily give up this very thin spread or the so-called liquidity, pay an extra nickel spread in exchange for a much safer, less volatile market.
Okay, so there's a question about essentially high-speed trading. I think you heard maybe a good part of that question, and maybe the concern for other investors. You'd probably do a better job of answering and summarizing than I'm doing, but
Sure. I think the basic suggestion was that because high-frequency traders and because the fragmented environment has basically eliminated effective market-making requirements even when they operate as market makers on the exchanges, that the net effect is negative and not liquidity providing. And then you call for a transaction tax, at least for trading away from exchanges, to discourage the activity to some degree. And raise money, as some politicians seem to have suggested, is a really good idea. I think I empathize with your concerns, but I think they're one-sided. I don't think the data really supports the conclusion that high-frequency traders, any less than the competitive traders that operated on the floors of the New York Merc and the Chicago Board of Trade in days before, which if you want to look at the trading strategies that high-frequency traders generally use, are the closest analogies, don't provide value from that standpoint. It really, as a long-term investor, I do like narrow spreads, and the statistics are difficult to come to any conclusion that they are narrower for the day-to-day activities, and that's not only important to me there, but probably way more important to me with respect to my mutual fund investments, where I particularly would like those mutual funds to be as efficient as possible. Now, the concerns are valid, as I said, and addressing the right things from the standpoint of short-term volatility, one of which ought to be talking about the fact that if you're an active high-frequency trader that is meaningful in the market, you have some level of, for lack of better words, social responsibility. And I think rethinking what market-making obligations may be appropriate for at least the largest high-frequency traders, as well as what incentives should exist there, because it's difficult to have one without the other, is very fair. And there are, certainly things like encouraging animals like IEX that provide a different environment, as well as ATSs that provide an environment, as long as they're telling the truth, where people can choose to trade in a less active trader environment, I think are good things. But I would be careful to sacrifice all of the efficiencies that existed by really chasing them out of the market. I think it's a more nuanced thing, but I do agree with you. Looking at the downsides of their activity is a very important thing to do.
yes, question at the back. Can you identify yourself and you got the mic?
I'm Mark Sheff with Investment News. Rick Finra wrote a comment letter that was highly critical of the DOL fiduciary rule. Have you had a chance to review the rule, and what do you think of the final rule, and what do you think of it?
I think the final rule is much better, and I think that I agree generally with much of the work done by analysts in evaluating it, and I think the steps done from an operational standpoint, particularly in not looking backwards with respect to existing investments and incentives that are already in there, and from the standpoint of the ability for negative acceptances with respect to the BIC or the contract that's involved in DOL are major steps forward. There's also some useful clarifications, though I'd love to see more detail with respect to the standards with regard to differential compensation for advisors. Great clarity from the standpoint of firms and their obligations with regard to third-party payments and proprietary products that I think is much more balanced, and I again give credit for the DOL for design changes that I think, as well as eliminating the blacklist of products that are very important. There still, to me, could be valuable in having greater guidance with respect to exactly how neutral factors that allow for some differentiation in compensation with regard to advisor compensation actually should work in reality. And I'm hopeful that, given the responsiveness DOL has had in the last few months, that interacting with the firms, they'll be able to provide greater guidance there. But no, I think, as you know, Mark, I strongly believe that we need to move to a fiduciary environment where there's clarity that the best interest of customers are put first. All my concerns with DOL is that be done in a way that doesn't force all customers either to be self-driven or to be in fee-only accounts, because the basic fact is, for most investors, fee-only accounts are more expensive, and self-driven investors, on any economic analysis I've ever done, do worse than investors that are advised. So I think I'm not smart enough, and I certainly haven't completed the evaluation to conclude, but I think DOL has taken major strides to get at the important steps from the standpoint of managing conflicts with respect to best interests without driving everything into either self-driven accounts or fee-only. Whether they've done enough, I think, we'll see, and certainly FINRA will look at very closely. And obviously, I continue to hope that eventually we have a single consistent standard driven by the SEC. But I give great credit for the DOL in making, I think, some very significant changes in this version.
Okay.
More than anybody besides Mark may have wanted to hurt.
No, that was very helpful. Yes, question here. Just wait for the mic. Thank you.
Sandy Apgar, friend of Brookings. What role are you personally and FINRA institutionally playing in improving economic and financial literacy, which I personally see as one of the underlying risks in the economy as a whole?
Boy, I could not agree with you more. I think it is.
Especially as we got people now managing their own.
Well, exactly. Obviously,
retirement.
that's the primary inflection point in the United States from the standpoint of shifting to defined contribution 401ks and IRAs, and the decision making involved there. Putting aside, talking about my kids' generation, the enormous leverage that has been built in without a lot of thinking of the cash flow returns on the other side with respect to huge concentrated student loans, which is as well are the type of decisions, putting aside the use of credit cards, that our millennial generation is faced with challenges that, frankly, I never had when I was growing up. So I think the answer is we have a foundation that we've just funded was fortunately funded from the bad actions of enforcement actions in the past, but we've just funded with an additional $50 million contribution a year ago that's absolutely focused on this. And I think the amount of economic literature from the standpoint of analyzing how investors and consumers make decisions is extremely encouraging. Short answer, our conclusions and what we try to do with respect to our foundation is look for leverage. There's plenty of stuff out there that provides wise guidance from the standpoint of making solid decisions with respect to the range of consumer decisions that you make. The question is getting studies that really cast clarity into the type of disclosure and variety of encouragements that can help from that standpoint. And then it is getting information for folks with different decisions and different economic levels, from the financially at risk to the better off, getting that information delivered ubiquitously through trusted persons. Because if it's not, we work with the libraries, we work with the United Way, we work with a variety of different entities embedded into the community that in one way or another can deliver and create incentives for trusted persons to interact with people so that we're not just putting crap out on the web that nobody's reading.
We're sort of running out of time. I had a couple more questions, so let's take both of them together if you can respond. So a question over there, and then we'll go right to a question here, and then get your response. Yes?
I'm Dave Michaels with the Wall Street Journal. Hi. You talked about August 24th. You said there were issues that were ripe for review, and you mentioned 4 or 5. What are the changes that the NMS plan amendment will recommend in terms of changes to limit up, limit down, or other sort of market stability mechanisms to address what happened on the 24th? And then could I ask a second question? Now that IEX has amended the way that their affiliated router, their router works, on balance, do you think that the IEX exchange should be approved?
Okay, and we'll take the next question here.
On the first one, I think that's...
Okay.
Okay, I'll just briefly say, Dave, on the first one, I think that's still a discussion among the exchanges, FINRA, and the SEC, and I do expect it to be a subject of discussion at the next advisory committee. So I don't think there's decisions. I tried to identify some of the areas that that I think are sort of no-brainers. You do have very brief time windows before the price reset occurs in limit up, limit down that cause some of the problems. We need to. There were specific separate requirements in ARCA from the standpoint of price movements that deserve to be looked at. Having the same restrictions and slowdowns when a stock is recovering, as sometimes occurs after this type of event, deserves to be rethought. And looking at the opening and the fact that there are way wider bands as well as bands applied during the trading around the opening are sort of some of the examples, as I said in my talk, that I think deserve to be looked at. But everything relates to everything else, and it'll come out. But I think all those things are things that certainly are being looked at by the plan, the SEC, and the advisory committee.
Okay, then quickly, our last question.
I'm talking about dark pool. I trade through a broker firm. Is not broker firm obligated to tell their clients that which securities are traded through dark pool and which are outside?
Yes,
because we don't get any information about what we are trading and how the prices are influenced.
This is where I'd love to see the 605 information from the standpoint of investors be much clearer from the standpoint of the execution that you get.
Just tell the audience the 605 regulation.
The SEC adopted two rules back 15 years ago that basically tried to increase information out for execution quality. But it did that in a world where still most of the trading occurred in exchanges. So I agree with you. There needs to be more disclosure to individual investors about dark pools. There needs to be more disclosure that allows individual investors to understand when their orders are being executed with respect to firms, not in dark pools, but firms from the standpoint of their own principal activity, that they can understand and evaluate the relative quality. Now, most individual investors aren't going to do that, but it's important they have the information, and of course, once that information is public, it gets looked at by media analysts and a variety of other things, and that tends to impact behavior.
Thank you so much,
Thank
Rick.
you.
Would you please join me in thanking Rick Ketchum?